Welcome to This Explainer. Look, if you've been following the financial headlines over the last few years, you know the narrative around commercial real estate has been pretty grim. But today, we're actually digging into the data to see the phoenix rising from those ashes. And let me tell you, the reality on the ground in 2026 is far more interesting than all that doom and gloom you might expect. I absolutely love this quote from John Allen Paulos. Uncertainty is the only certainty there is, and knowing how to live with insecurity is the only security. I mean, doesn't that just perfectly capture the wild, completely unpredictable ride the commercial real estate market has been on? We went straight from a decade of cheap money and super stable valuations right into a period where the very purpose of a physical building was called into question. Navigating this space has required a massive mindset shift. So here is our roadmap for today's explainer. We'll start with 1, the real estate crash, then move into 2, anatomy of the distress, 3, the 2026 market recovery, 4, a cycle of selectivity, and finally, 5, the future of space. All right, let's jump into section 1, the real estate crash, and specifically the pre-existing conditions. You know, we often blame the pandemic for everything, but the truth is the commercial real estate market was fighting a massive office surplus and a fierce retail apocalypse long before 2020 even began. The US office glut was actually a decades-long problem. It was fueled by overdevelopment and older tax code changes, and then compounded by a historic leasing slump left over from the 2008 financial crisis. Meanwhile, that so-called retail apocalypse was already severely accelerating by 2017 as e-commerce giants fundamentally changed how we shop. That left massive corporate debt and empty brick-and-mortar stores in its wake. So the kindling for a crisis, it was absolutely already there. Moving right along to section 2, anatomy of the distress, or what I like to call the perfect storm. So the spark finally hits that pre-existing kindling. And man, it was a rapid sequence of events. In March 2020, we had the abrupt worldwide shift to remote work. By April, Castle Systems, they're the ones tracking security card swipes in commercial buildings, they saw office occupancy plummet to a shocking 18%. Then, the crisis compounded globally. September 2021 rolls around, and the Chinese property giant Evergrande warns of an offshore bond default, sending shockwaves everywhere. And just as the dust tried to settle, 2022 brought surging global inflation, which prompted central banks to trigger really aggressive interest rate hikes. Borrowing costs spiked almost overnight. And it's absolutely crucial to remember that this pain wasn't localized. It was a true global distress wave. It shook the foundations of massive property sectors, from the US all the way over to China. That brutal combination of suddenly empty buildings and incredibly expensive debt just became this universal language of distress across the globe. Which brings us to the present day. In section 3, the 2026 market recovery, and how valuations are finally stabilizing. Now, you might be scratching your head wondering, well, why do we still hear about foreclosures and loan modifications if the market is actually recovering? Well, real estate distress is a classic lagging indicator. That's a measurable economic factor that changes only after the economy has already started following a new trend. To put it simply, the rain has stopped, but the floodwaters are still draining. Historically, REITs hit bottom first, which they actually did back in 2023, and then private valuations start to recover. Delinquencies are the very last things to peak, usually 12 to 24 months later. So seeing distress now actually means this system is working through its necessary reset, not breaking down. And honestly, this number is absolute proof of the thought, 47%. We are seeing a massive 47% year-to-date increase in US commercial real estate loan originations compared to 2024. This means the debt markets are wide open, they are liquid, and lenders are finally confident enough to start deploying major capital again. At the exact same time, we're seeing a 17% jump in transaction volumes in the US. This is huge. It shows us that buyers and sellers are finally agreeing on valuations again after years of a completely frozen market. Confidence is definitively on the upswing across the board, and capital is flowing right back into the physical economy. All right, section 4, a cycle of selectivity, focusing on the widening dispersion in the market. Because as we enter this recovery, you have to understand that a rising tide is definitely not lifting all boats. We are seeing incredibly diverging realities, a real tale of two cities. On one side, older, obsolete offices are caught in a doom loop. They're plagued by high vacancy rates, physical obsolescence, and turning into stranded assets no one wants to touch. But on the flip side, we are seeing a massive flight to quality. Investors and tenants are happily paying a premium for state-of-the-art properties, prime retail spaces, and buildings meeting strict sustainability and ESG standards. Take the industrial and logistics sectors, for example. These sprawling logistics parks remain incredibly resilient. They're heavily driven by rapid advancements in warehouse robotics and AI. Supply chains are modernizing at lightning speed right now, and the physical space required to support that high-tech infrastructure is highly prized. And then we have what I like to call the retail renaissance. Who saw this coming? After 2 decades of profound pain, retail has bounced back incredibly strong. Why? Well, all that pain forced a significant repricing over the last 5 to 8 years. Plus, there's been a historic lack of new retail development, which means supply is severely limited. Add in institutional investors rotating out of tech stocks and back into the real economy, and suddenly retail has re-emerged as one of the most competitive and investable sectors in 2026. Even the heavily battered office sector is seeing spectacular pockets of revival. JP Morgan's new global headquarters in Midtown Manhattan is the perfect example of this flight to quality. It's an all-electric, net-zero emissions tower packed with over 100,000 sensors, meditation spaces, and state-of-the-art wellness centers. Buildings like this are driving record rents, simply because companies realize that to earn the commute from their employees, the office has to be truly spectacular. Let's look ahead to our final chapter, Section 5, the future of space and the structural themes impacting real estate. Investor strategies today are being shaped by an incredibly complex web of structural transformations. It's not just about interest rates anymore. Investors are underwriting macroeconomics like sovereign debt, geopolitical shifts in trade, massive technological leaps in AI and the Internet of Things, and fundamental demographic changes like aging populations and shifting global migration corridors. This interconnected web is exactly what dictates what gets built and where. And because of all that complexity, the days of passive ownership, they are completely fading. You can't just buy a building, hand the keys to a property manager, and sit back waiting for the rent checks. Today's market requires deep, hands-on operational expertise. To create true value now, owners need marketing savvy, hospitality skills, and a deeply customer-facing mindset. Real estate is no longer just a passive financial asset. It's an active, highly operational business. So as this intense cycle of selectivity reshapes our cities right from the ground up, I want to leave you with a final thought to consider. Think about the malls, the offices, and the warehouses in your own life, right in your own neighborhood. Are they stuck in the doom loop, or are they part of the flight to quality? How will the spaces you use transform next? Thank you so much for joining me on this explainer. Keep your eyes on the skyline, and I'll see you next time.